Welcome to the whiteboard. Okay, so today we're diving straight into the ultimate strategic blueprint for mastering what is probably the trickiest, most dense module in the entire 2026 IGCSE Accounting 0452 syllabus. Yep, we're talking about the provision for doubtful debts. Now, if you're aiming for that A-star grade, you are absolutely in the right place. See, this isn't just about basic record keeping. This is the bridge between simple data entry and high-level financial intelligence. So grab your whiteboard markers and let's decode this syllabus together.
Here's the four-pillar roadmap we're going to follow today. Number 1, a rapid concept recap. Number 2, step-by-step technical execution. Number 3, ratio interpretation and valuation. And number 4, advanced examiner insights.
All right, kicking things off with Section 1, the core accounting concepts.
First up, we've got a massive terminology update. For the 2026 syllabus, Cambridge requires total 100% accuracy with their new wording. You absolutely must use the term irrecoverable debts when talking about debts that definitely cannot be collected. This is a huge shift, and it's fundamentally different from a doubtful debt, which, is just a debt we suspect might go bad. Using the old terms, that's going to cost you marks. So you've got to show the examiner you're perfectly fluent in the 2026 standards by clearly separating the irrecoverable from the merely doubtful. Alongside that, you really need to nail down the exact term owner's equity. This represents the owner's residual interest in the business assets after deducting liabilities. Now, why does this matter so much for our topic today? Well, think about it. When we create or increase a provision for doubtful debts, we're essentially recording an expense, right? And what do expenses do? They reduce profit, which, in turn, directly reduces owner's equity. It's like a domino effect. You always have to keep in mind how this single adjustment ripples all the way through to keep your fundamental accounting equation perfectly balanced. And that brings us to a really massive conceptual hurdle, the prudence concept. Think of prudence as your ultimate financial shield. It literally dictates that we must never overstate our profits or our asset values. Actually, this is the exact reason the provision for doubtful debts even exists in the first place. If we know, say, a certain percentage of our credit customers might not pay us back, ignoring that fact would artificially inflate the true value of our trade receivables. We'd be kidding ourselves. So we have to be prudent, anticipate the loss, and keep the reporting completely transparent. Moving right along to Section 2, step-by-step technical execution. Okay, let's walk through a quick worked example to map out the exact chronological journey of a transaction. Imagine you need to increase your doubtful debt provision at year-end. Where does it start? Right in your general journal, your primary book of prime entry. From there, you post the double entry to your T accounts. You debit the income statement, and you credit the provision for doubtful debts account. Finally, this updated, totally accurate balance flows seamlessly straight into your trial balance and right on to your final financial statements. It's a strict step-by-step flow.
Now, I've got some absolutely phenomenal news for your exam technique. Whenever you see the specific IGCSE command word calculate next to a provision adjustment, you have to secure what we call method marks. Listen to this. Examiners will actually award you marks just for showing a visible logical flow in your workings, even if your final math is slightly off. Seriously. So treat your paper like you're an academic coach showing your work. Write down every single step. It's literally your ultimate safety net.
And speaking of safety nets, meticulous T-account structure is the gold standard of double-entry bookkeeping. For a provision for doubtful debts account, it is vital to remember that it holds a credit balance. You have to clearly distinguish between your balance brought down, that's the B- on the credit side to start the new financial year, and your balance carried down, or C- entered on the debit side at year-end to balance the whole thing out. Mixing these two up, it's a super fast track to losing incredibly simple technical marks. Don't let it happen to you.
Now, it's pretty easy to fall into general math traps, like, miscalculating trade versus cash discount percentages, or forgetting your state symbols in manufacturing accounts. But there is a far more dangerous trap specifically waiting for you in doubtful debts. The absolute most common student mistake, the one that drives examiners crazy, is calculating the provision percentage before deducting the actual irrecoverable debts from the trade receivables balance. No way. Always subtract your confirmed bad debts first and then apply your provision percentage to whatever is left. That guarantees 100% accurate trial balance phase. All right, we're leveling up now to Section 3, Ratio Interpretation and Evaluation. Remember, this is Assessment Objective 3. When an exam question hits you with the command word evaluate,
just calculating the ratio is only the baseline. Interpreting what it actually means is what gets you the A star. For instance, imagine you're looking at a business's current ratio, and it drops from a super healthy 2.5 to 1 all the way down to a really concerning 1.1 to 1, and this happens over just a single trading period.
So, I want you to literally pause the explainer right here. Put on your financial analyst hat and try to answer this. Why did the current ratio fall so drastically? What's actually happening beneath the surface numbers to cause such a severe liquidity issue? Go ahead, pause the explainer, jot down your thoughts, and then hit play when you're ready.
Welcome back. Okay, let's see if you caught the potential causes. Did the business maybe overpurchase inventory? Are their cash reserves completely depleted from some heavy capital expenditure? Or, and this ties right back to our main topic today, are their trade receivables totally bloated with debts that are becoming more and more doubtful, essentially freezing up their liquid cash? Digging under the surface to diagnose the real health of the business, that is exactly how you score top evaluation marks.
And this evaluation skill is absolutely critical when you're comparing two different firms. Think about it. Just like you might compare one firm using the straight line depreciation method with another using the reducing balance method, you'll see firms using totally different policies for their doubtful debt provisions. One company might keep a super strict 5% provision, while another might only provision 2%. Because they use different internal policies, making a direct apples-to-apples comparison is incredibly difficult. You really have to explain to the examiner exactly why comparing those surface-level numbers could be totally misleading.
Looking beyond the numbers also means analyzing the actual quality of the profit. And to do that, you've got to look at crucial non-financial factors. We're talking about things like staff morale, the business's location, their market reputation, or even how efficient their credit control team is at actually chasing down late payments so they don't become doubtful debts in the first place. These elements are nowhere to be found in the accounting ledgers, right? But they heavily impact long-term sustainability. Bring these non-financials up in your written answers, and you will seriously impress the examiner. Okay, let's wrap this up with Section 4, Advanced Examiner Insights.
I'm going to give you a peek behind the curtain at what principal examiners consistently flag in their reports. First up, failing to distinguish between revenue items and capital items. This is a huge reason students bleed critical marks. Look, revenue items are your day-to-day running costs, like routine repairs. Capital items are your long-term asset investments, like buying a whole new piece of machinery. If you accidentally post a routine repair to a machinery asset account, boom, your profit is instantly wrong, your total asset value is wrong, and any performance ratios based on those numbers will be completely fundamentally flawed. Always double-check your classifications. Now, pulling directly from recent examiner reports, here is your definitive 0452 exam survival checklist. Number 1, maintain clear handwriting in your ledger accounts. It sounds silly, but if the examiner can't read your balances, you lose the mark, period. Number 2, master precise time management. And number 3, pay super close attention to question part weightage and command words. A 12-mark evaluate question demands deep analysis and non-financial factors, whereas a 2-mark state question, that just needs a quick factual answer. Don't overcomplicate it.
So, what does this all mean for you? Are you ready to apply the prudence concept, secure every single method mark, and completely conquer your IGCSE accounting exam? Because you've now got the blueprint. You know the updated 2026 terminology, you know exactly which calculation traps to dodge, and you know how to evaluate ratios like a top-tier analyst. Stick to the strategy, structure your revision effectively, and go grab that A star. Thanks so much for hanging out with me on this explainer.